Most people hear the words index fund and instantly assume it's one of those boring financial terms that only matters if you already have money, already understand the stock market, or already have your life together. It sounds like something a guy in a suit says on a business channel right before flashing a chart across the screen and telling you to think long term. But here's the truth. If you've ever felt confused about investing, intimidated by all the different options, or secretly worried that building wealth is way more complicated than people make it sound, then understanding what an index fund is might be one of the most important financial shifts you ever make. Because once you understand it, a lot of the noise starts to disappear. The stock market stops feeling like a casino. Investing stops feeling like a game designed for insiders. And wealth building stops looking like something reserved for finance nerds, trust fund kids, or people who somehow figure all this out at 22. An index fund is one of the clearest examples of how ordinary people can use a very simple system to build serious wealth over time, without having to constantly predict what the market will do next. At its core, an index fund is just a collection of investments bundled together into one fund that is designed to track a specific market index. That's the formal definition, but if you're new to this, that probably still sounds vague. So let's make it real. Imagine you wanted to invest in the biggest companies in America. You could try to pick them one by one. You could buy a little Apple, a little Microsoft, maybe some Amazon, maybe Google, maybe Nvidia, maybe a few banks, maybe a healthcare company, and hope you chose well. But that takes time, knowledge, emotional control, and a willingness to be wrong a lot. An index fund skips most of that complexity. Instead of trying to pick winners yourself, you buy one fund that already holds a large group of companies for you. So instead of betting on one or two companies and hoping you got lucky, you're buying a slice of a whole market. That's the real appeal. You're no longer relying on your ability to guess which company will dominate over the next 10 years. You're letting the market do the sorting while you focus on consistently owning a piece of it. That sounds simple, and honestly, that's because it is. But simple and easy are not the same thing. The reason index funds matter so much is not because they're exciting. It's because they remove a lot of the mistakes people make when they first start investing. Most beginners don't lose because they're dumb. They lose because they get pulled into complexity, hype, fear, and the constant feeling that they need to do something clever to get ahead. They think investing means finding the next big stock, timing the perfect moment, or building some complicated portfolio that makes them feel sophisticated. But in reality, a lot of wealth gets built in a much quieter way. Think about how most people approach money when they're first trying to improve their life. They usually start from one of two places. Either they're overwhelmed and doing nothing, or they're consuming endless content and jumping between strategies every week. One day it's dividend stocks. The next day it's crypto. Then it's real estate. Then it's options. Then someone says the market is about to crash, so now they're frozen again. It becomes mental chaos. And when money already feels stressful, chaos is the last thing you need. That's where index funds become such a powerful concept. They introduce structure. They simplify the decision. They reduce the emotional burden. Instead of asking yourself which stock to buy, when to buy it, whether it's too late, whether the CEO is better than that one, whether tech is overvalued, whether you should wait for a dip, you start asking a much better question. How much can I consistently invest into the market over time? That is a completely different mindset. It shifts you away from prediction and toward participation. And that shift matters more than most people realize. Because when you stop obsessing over picking the perfect investment, you free up mental energy to focus on the part that actually builds wealth for most people: consistency. Let's say you buy an index fund that tracks the S&P 500. That fund gives you exposure to 500 of the largest publicly traded companies in the United States. You're not buying one company. You're buying a small piece of hundreds of them all at once. If one company struggles, that doesn't destroy your investment. If one company explodes in growth, you benefit from that too. The risk is spread out. The upside is shared. And most importantly, you don't have to constantly manage every piece of it yourself. That idea alone can be life-changing for someone who has always thought investing was only for people with special knowledge. Because the truth is, Most people do not need a genius-level strategy. They need a strategy they can understand, trust, and stick with when life gets noisy. An index fund does exactly that. It gives you diversification, simplicity, and market exposure in one move. Now, to really understand why this matters, you have to understand how most people accidentally sabotage themselves. They start investing with excitement, but no framework. They buy random stocks they heard about online. They chase performance. They panic when prices drop. They sell when they should hold. They buy when everything is already expensive because they feel like they're missing out. In other words, they let emotion drive the process. And emotion is expensive. Index funds are powerful partly because they protect you from your own worst instincts. They don't eliminate risk. No investment does. But they reduce unnecessary risk. The kind of risk that comes from ego, impatience, overconfidence, and panic. Instead of building your portfolio around your opinions, you build it around a system. And systems matter because your future wealth usually depends less on one brilliant move and more on repeated good behavior. That may not be sexy, but it's real. A person who invests in a simple low-cost index fund every month for years is often in a much stronger position than someone who keeps trying to outsmart the market and keeps resetting their progress. There's also a psychological benefit here that doesn't get talked about enough. When your investing strategy is simple, your life gets quieter. You stop checking the market every 5 minutes. You stop reacting to every scary headline. You stop feeling like every dip means you did something wrong. You understand that volatility is part of the process, not proof that the system is broken. That kind of calm is incredibly valuable, especially if you already come from a place of financial stress. A lot of people don't realize that one of the biggest barriers to building wealth is not lack of intelligence. It's lack of confidence. Not fake confidence, real confidence. The kind that comes from understanding what you're doing and why you're doing it. Index funds help create that. They give beginners a way into investing that doesn't require pretending to be an expert. And for many people, that's the difference between staying stuck and finally starting. The beautiful thing is that index funds align with how wealth is actually built for a lot of ordinary people. Slowly, consistently, without applause, without drama, without having to win every day. You don't need to be right about every company. You don't need to predict recessions. You don't need to beat Wall Street. You just need to keep buying a productive slice of the economy over time and let compounding do what it does. That might sound too simple to matter, but that's exactly why it works. People often assume that if something is effective, it must also be complicated. But in money, complexity often feels smarter than it performs. And simplicity often feels boring right up until it starts working. The more you sit with that idea, the more powerful it becomes. Because an index fund is not just a product. It's a philosophy. It's a way of saying, I do not need to be the smartest person in the market to benefit from the market. That is a massive mental shift, especially in a world where everything pushes you to believe the opposite. Social media tells you someone is getting rich overnight. Finance content tells you there's always a hidden strategy, a better play, a more aggressive move, some underpriced opportunity you're missing. And if you're not careful, you start feeling like simple investing is somehow lazy or unsophisticated. But that's one of the biggest traps beginners fall into. A lot of people delay investing because they think they need to know more first. They think they need to understand every sector, every economic cycle, every earnings report, every ratio, every chart pattern. So they stay in research mode for months, sometimes years, while their money sits still. What makes index funds different is that they give you a way to start before you know everything. And that matters because time in the market is usually more important than waiting until you feel perfectly ready. Let's make this even clearer. Imagine two people. The first person spends 2 years trying to learn how to pick the best stocks. They watch videos, read threads, follow market news, and keep telling themselves they'll invest once they feel more confident. The second person spends those same 2 years putting money each month into a low-cost index fund. By the end of that period, the first person may have more opinions, but the second person has something much more useful: ownership, experience, and momentum. That's what index funds really give you. They lower the barrier to action. They take something that feels intimidating and make it manageable. And for a lot of people, manageable is exactly what they need. Not because they lack ambition, but because real life is already demanding enough. You have bills, responsibilities, work stress, maybe debt, maybe family pressure, maybe a brain that is already overloaded. You do not need an investing strategy that adds more chaos. You need one that lets you move forward with clarity. Another thing that makes index funds so powerful is diversification. That word gets thrown around a lot, but what it really means is simple. Don't let your financial future depend too heavily on one thing. If you buy one stock, your results depend heavily on that one company. If that company stumbles, your money takes the hit. But if you own an index fund made up of hundreds of companies, one bad result matters a lot less. You're spreading your risk across a broad group instead of concentrating it in one place. This is one of the most overlooked forms of financial peace. Because when you're diversified, you don't have to live and die with every headline about one company. You don't need to pray that one CEO makes perfect decisions. You don't need to panic because one product launch failed or one earnings report missed expectations. Your portfolio becomes less fragile. And fragility is expensive, not just financially, but emotionally too. That emotional part matters more than most people admit. A strategy only works if you can stay with it. If your investments make you anxious all the time, if every price drop makes you question yourself, if every market dip tempts you to sell everything, then even a technically good strategy can fail in practice because you won't stick to it long enough. Index funds help reduce that emotional noise because they are built around the idea that the market as a whole will have ups and downs. But over long periods, productive businesses tend to grow. That doesn't mean index funds are magic. They go down too, sometimes sharply. If the market drops, your index fund drops with it. That part is important to understand. Index funds are not a shortcut around volatility. They're a way to own volatility in a more balanced, less reckless way. You are still exposed to the market, which means you still need patience. You still need discipline. You still need to understand that short-term declines are part of long-term investing. And that's where a lot of beginners get tripped up. They think a good investment should always feel good. But that's not how wealth building works. Good investments often feel boring in the good times and uncomfortable in the bad times. Index funds are no exception. In a bull market, they may feel too slow compared to whatever stock is doubling that month. In a downturn, they may feel scary because your account balance is lower than it was before. But neither feeling should be in charge. That's the whole point. A strong strategy is supposed to survive your emotions, not obey them. This is also why fees matter so much. One reason index funds became so respected is that many of them are low cost. That means they charge very little to own. At first glance, that may not seem like a big deal. A small fee sounds harmless. But over time, fees quietly eat into your returns. And because investing is all about compounding, even small differences can have a bigger impact than people expect. If one fund charges much more than another, that extra cost keeps taking a bite out of your growth year after year. So when people talk about index funds, they're often talking about two huge advantages working together: broad diversification and low cost. In other words, you're getting exposure to many companies while keeping more of your own money working for you. That combination is hard to beat, especially for beginners who do not need more complexity. They need more efficiency. There's also something humbling about index funds that is surprisingly useful. They force you to accept that you do not need to dominate the market to build wealth. You just need to participate in it. That may sound small, but for a lot of people, it removes the pressure that keeps them on the sidelines. You don't need to have a hot take. You don't need to know which sector will outperform next quarter. You don't need to reinvent investing. You just need a way to own a broad slice of economic growth and keep adding to it over time. And once that clicks, your whole relationship with investing starts to change. You stop seeing it as a performance stage where you have to prove how smart you are. You start seeing it as a quiet system that rewards patience, consistency, and emotional control. That is a much healthier foundation for someone trying to build long-term wealth. This is especially important if you come from a background where money has always felt unstable. If your financial life has mostly been about surviving, fixing problems, or catching up, then you do not need an investing strategy built on constant decision-making and high stress. You need something that helps you move from chaos to structure. Index funds do that extremely well. They take the pressure off your need to be right all the time and put the focus back where it belongs. Regular investing, long-term thinking, and letting time do its work. In a weird way, index funds can also teach you a bigger life lesson. They teach you not to confuse activity with progress. A lot of people think doing more means achieving more. More trades, more research, more changes, more strategies. But in money, that instinct can become self-sabotage. Sometimes the person making fewer moves ends up much further ahead because they avoided the mistakes that come from constantly interfering with the process. That's why index funds are so often recommended to people who are serious about building wealth, but not interested in turning investing into a full-time hobby. They respect your time, they respect your attention, and they let you keep your life focused on earning, saving, and living well instead of endlessly managing a portfolio that may not outperform anyway. At the end of the day, an index fund is a tool. But for many people, it becomes something bigger than that. It becomes the first investing concept that finally makes sense. The first one that feels realistic. The first one that doesn't require pretending. And sometimes that is the moment everything starts to change. Because once investing feels understandable, it becomes doable. And once it becomes doable, consistency stops feeling impossible. So if you strip away all the jargon, all the noise, and all the unnecessary complexity, what is an index fund really? It is a simple way to buy a broad piece of the market in one move. That's it. It doesn't promise you instant wealth. It doesn't make you smarter than everyone else. It doesn't let you skip risk. What it does do is give you a practical, proven, low-drama way to start participating in long-term wealth building without needing to become a stock-picking expert first. And honestly, that is a bigger deal than it sounds. Because most people don't need another complicated financial concept thrown at them. They need a path they can actually follow. They need a way to move from confusion to clarity, from hesitation to action, from feeling like investing is for other people to realizing it can be for them too. That's why index funds matter so much for ordinary people. They meet you where you are. If you only have a small amount to invest, an index fund can still make sense. If you don't have time to research individual companies every week, an index fund can still make sense. If you know enough to realize that you should probably be investing, but not enough to trust your own stock picks, an index fund can still make sense. It works for people who are busy, people who are cautious, people who are just beginning, and even people who know quite a bit about investing but still prefer a strategy built on simplicity. There's something deeply reassuring about that, because a lot of financial content makes it sound like every dollar has to be optimized with military precision. Like if you don't choose the perfect investment immediately, you're falling behind. But an index fund cuts through that pressure. It says you do not need perfection to begin. You need a sound process. That may not feel exciting, but it is often exactly what leads to real progress. Now, that doesn't mean every index fund is identical. Some track the S&P 500. Some track the total U.S. stock market. Some focus on international markets. Some track bonds. Some track specific sectors. So when people say index fund, they are describing a category, not one single investment. But the core idea stays the same. The fund is trying to follow an index, not beat it through constant active decisions. It is designed to mirror a market segment rather than guess its way around it. That difference matters because it shapes what you should expect. With an index fund, you're not trying to be exceptional. You're trying to be effective. You're not trying to find the one winning stock. You're trying to own enough of the market that you benefit from broad economic growth over time. That may sound modest, but over years and decades, modest systems often beat emotional behavior. This is where a lot of beginners finally breathe easier. Because once you understand index funds, investing starts to feel less like a test and more like a habit. You stop asking, what if I pick the wrong stock? And start asking, how can I keep buying into the market consistently? That is a much stronger question. It shifts the focus away from fear and toward process. And process is what carries people when motivation fades. Think about the difference between trying to get rich quickly and trying to build wealth steadily. One mindset is built on urgency, excitement, and pressure. The other is built on patience, structure, and repetition. Index funds belong firmly in the second category. They are not flashy enough for people who want instant results. They are too calm for people addicted to action. But for someone who wants to build something durable, that calm is a strength. And maybe that is the biggest thing people miss. A good investment strategy should not constantly pull you into emotional chaos. It should reduce chaos. It should help you stay invested when headlines get dramatic. It should help you avoid the trap of constantly changing direction. It should fit into your life in a way that feels sustainable, not exhausting. Index funds do that better than most people realize. They also quietly reinforce one of the most important truths in personal finance. Wealth often comes from boring behavior repeated for a very long time. Saving every month, investing every month, staying invested, ignoring hype, keeping costs low, letting compounding work. None of that makes for a glamorous story at a dinner party, but it does make for a strong financial future. And if you're someone who spent years feeling behind, feeling confused, or feeling like everyone else got the investing memo except you, this should be encouraging. You do not need to catch up by making some huge, risky move. You do not need to erase years of hesitation with one brilliant decision. More often, you catch up by finally choosing a simple strategy and sticking with it long enough for it to matter. That's the beauty of an index fund. It gives you a place to begin without demanding that you become someone else first. You don't need to become more aggressive. You don't need to become obsessed with markets. You don't need to become a finance personality. You just need to become consistent. And for most people, that is far more realistic than trying to outsmart professionals. Of course, consistency only works if you understand what you own. So let's make the final distinction as clear as possible. An individual stock is one company. An index is a list or benchmark representing a part of the market. An index fund is a fund built to follow that index by holding the investments inside it or reflecting them closely. That means when you buy an index fund, you are buying into a system that spreads your money across many investments according to a specific structure. You are not making one narrow bet. You are buying broad exposure. That broad exposure is what helps make index funds such a foundational tool. They are not the answer to every financial problem, and they do not replace the need for budgeting, saving, emergency funds, or patience. But once those basics are being built, index funds often become the bridge between earning money and actually growing it. And that bridge matters because a lot of people spend years working hard without ever giving their money a real job. They earn, they spend, they recover, and they repeat. But at some point, if you want a different future, your money has to start doing some work too. Not through magic, not through hype, through ownership, through compounding, through time. Index funds offer one of the simplest ways to begin that process. So when someone asks, what is an index fund? The technical answer is easy. It's a fund that tracks an index. But the more meaningful answer is this. It's a tool that makes investing feel possible for normal people. It turns a confusing world into something more manageable. It helps shift your focus from trying to be clever to trying to be consistent. And for a lot of people, that shift is the one that changes everything. If you've been waiting until you feel smarter, richer, or more confident before taking investing seriously, this is your reminder that understanding one simple idea can be enough to get moving. Not because it solves everything overnight, but because it gives you a clear foundation. And in money, a clear foundation is powerful. It lowers stress. It reduces hesitation. It helps you stop treating wealth like a mystery and start treating it like a system. That is what an index fund really offers. Not excitement, not status, not financial theater. Just a quiet, effective way to own a piece of growth and let time work in your favor. And sometimes the most powerful financial decision you can make is not the one that feels impressive in the moment. It's the one simple decision you can keep repeating for years.